While headlines swing between the opening and closing of the Strait of Hormuz, price action remains the more reliable leader across markets, especially crude oil. Hello everyone, this is Razan Hilal, market analyst with Forex.com, live from Dubai. Today is April 20, 2026. So as I mentioned in my previous crude oil analysis, on the 2-week time frame, we had 3 scenarios defining long-term levels that separated between long-term bullish forecasts, neutral to bullish forecasts, and long-term bearish forecasts on the crude oil chart. And the first barrier was the highs of 2023 between the $88 and the $93 zone, where crude oil prices managed to break from last week following the news over the opening of the Strait of Hormuz, which was later reversed across the weekend. However, markets are still optimistic for near-term resolution and near-term opening of the Strait, keeping crude oil's price action in a relative bearish territory to March and the beginning of April, where we managed to have an extended drawdown towards the barrier of the bearish scenario, which represents the highs of last year's Middle East conflict, also involving the US, Israel, and Iran, between the $76 to the $74 price zone. Now, if we look at the daily time frame, we can see a potential head and shoulders pattern formation near the highs of this year, possibly giving the way for a reversal for the price action. Now, we did not manage to have did not manage to trace towards a full pattern potential target. We only managed to do that, or the price action only dropped halfway through the target. A clean breakdown below the 76 mark is expected to extend the full target towards the $67 zone, which aligns with the previous support and resistance to price action on the charts, at least since 2019. Now, from the upside, should price action climb back above the $93 zone or above the $88 to the $93 zone, we can be expecting bullish forecasts or short-term bullish forecasts to revisit the $100 to the $115 zone first, and a clear breakthrough above this critical resistance zone is expected to extend prices to another leg higher this year, aligning with key levels between the 135 and 157. And these levels can be derived using Fibonacci extension tool, placed between the lows of 2020 minus the extended volatility, the highs of 2022 also minus the extended volatility, and the lows of 2026, where we can see that the latest rejection was near the golden 618, near the 118 mark, and the next levels up are near the 786, near the 135 mark, and the 157 near the 100% Fibonacci extension for another potential resistance level on the horizon should the strait remain closed, or should geopolitical risk premium rise again across the markets.